All right, ladies and gentlemen, CEO and founder of Global Currencies. My name is Devon Bell, and today we're getting started with Course 5, otherwise known as Forex 105. And for those of you who don't know, this is the last course in the orientation. So we're going to go ahead and kick it off with some of the basics. All right, so we're going to go ahead and kick it off with margin, which is a question I've been getting asked a lot. What is it? How do we figure it out? And so I've dedicated this entire section to margin. But first, we're just going to start off what margin is. And in Forex, we're in a leverage-based trading environment. And margin, whether you deposit or transfer money into your account, margin is the volume that you're able to trade with based on that balance. All right, which brings us to leverage, which is, the next. Margin and leverage go hand in hand. Leverage mathematically is defined as a reciprocal of margin. Write that down. Economically, it is viewed as a borrowing instrument. So just for an example, if your account is leveraged at 1-to-1, you're only using your money when you trade. If it's higher than that, you're not using your money. The remaining margin requirement that you're actually using comes from liquidity providers, which is the step above the broker. Trading with an over-leveraged account can increase your chances of getting margin called. And if your account gets blown, right, if it gets a margin closeout, then that your account balance is no longer there. You're either zeroed out in the negative. That money then goes to the broker. But the liquidity provider's money was never in jeopardy, because in this situation, for us day traders, the liquidity provider is our market maker, right? They control the prices of the market. And so it's no different if you were invited to play, poker at your friend's house. It was only going to be the two of you, right? Now, the brokerage is the middleman, so in this situation, we'll push them to the side, right? Now, it's just you and your friend, which is the liquidity provider, right? You get there and he tells you, the buy-in to play is going to be $100. And before you even sit down, you have to have at least $1,000. So unaware of this, let's say you told him, I only have $100 in cash, right? He says, don't worry about it. I'll cover you for that other $900 if you need it. If it comes down to it, the other $900, I got it. All right. So as you sit down, do the math, and you realize, you're leveraged at 900-to-1. Now, in this case, as soon as you place a trade, your leverage would change, whereas a broker, your leverage would be fixed, ideally. So technically, whether you win or lose the next hand, your friend, he's not losing any money. Now, potentially, yes, he could, but you would have to win $1,900, starting with just $100. You have to take your $100 account and, get to $1,900 before your friend even lost any money. So the odds are in his favor. But now in the real world, it would take hundreds of billions of dollars before the liquidity provider would actually lose money, right? And I'm not saying that's impossible, but you would have to be making hundreds of billions of dollars before the liquidity provider lost money. All right. So that's a more in-depth view of leverage. Now, margin used, basically, how much equity is being used across all your open trades. Now, if you place trades, like let's say you place 2 trades, we'll get into the calculations and stuff in the next lesson, but if you place 2 trades, your margin used is going to be higher than if you were placing 1 trade, or if you placed 2.5 trades, or 2 trades that were, half a standard, your margin used is gonna be more than if you just placed, 0.1. All right. Now your available margin, the net asset value minus margin used. All right, where the net asset value is the entire equity of your account, including your account balance as well as any floating profit you have on the account. And floating profit is just a term. You could have floating profit be in the negative, and so your available margin would be less, right? Or if you have floating profit and they're in profit, your available margin would be more. Now, margin requirements. All right, this is the margin required for whatever pair you're trading, and this depends on your broker, because some pairs from different brokers will require more margin to be used than others, where the required margin will be in reflection of your account's net asset value and your account's leverage. All right, so we talked about the net asset value and we talked about your account's leverage. So here's an example that I found. If your broker requires 2%, which translates into 50 to 1 leverage, and we'll go over that in the calculation on the next lesson. But let's say your broker requires 2% on your USD and you selected 5% margin, which translates into 20 to 1 leverage of your account. Your margin requirement will be greater of the two. It'll always be the greater of the two, which in this case is 5%. So in this same situation, going with the 5%, you're going to need more money. You require more margin in order to trade. And so, someone who's leveraged at 1,000 to 1 versus somebody who's leveraged at 50 to 1, if they both have $100 in their account, the person who's leveraged at 1,000 to 1, they're going to be able to place higher lot sizes. They're going to be able to open more trades, 20 times the amount of trades as the person who's leveraged at 50 to 1. So theoretically, they will inherit profit 20 times faster than the person leveraged at 50 to 1. But that goes back to, when we were defining margin and leverage, because you don't want to be over leveraged, because you can also lose money 20 times faster. So this brings us to margin level, right, which is a percentage. You'll see this on MetaTrader 4 or whatever trading platform you use. You always see margin level, and what this is your available margin versus the used margin. Now, margin levels and margin calls and margin closeouts, which are the next definitions we're going to go over, they all go hand in hand, and I'll kind of explain that as we go along. Now, margin call, a margin call is not literally a phone call, but it's an alert. You'll either get an email, you'll get a text message. Your broker will notify you when you get a margin call. And this really gives you two options. You either put more money into that account to, if you're confident that it's going to go the original way that you intended, you put more money in the account and it will give you more margin. So your margin level will increase. But if you're not confident, you can, if you have multiple trades open, start closing, pick and choose which trades you want to close. That will also increase your margin level. It won't increase your available margin, because if those trades are at a loss, you're losing money as you're closing those losing trades. But it will increase your margin level. So, you have to really sit down and think. Do you want to close a trade that is the most negative? Does it follow your risk to reward ratio? And if it does, or if it doesn't, then go ahead and close, take that biggest loss, so those other trades will still have time to, fully utilize your risk to reward ratio. Um, but ultimately, you could close out everything, and your account would not be blown. It would be close to it, but it would not get blown. You'd have approximately anywhere from 30 to 50% of what you initially had, which is better than 0% or owing the brokerage money, right? And so, like I said, if you see a strong reversal or retracement and you have multiple indications that your trade is about to head in the right direction, then and only then should you ignore the margin call and keep the trade alive. All right, but that's the only time. I don't care if you see one pattern or one news alert. I want you to have multiple indications that your trade is about to reverse. Then and only then can you ignore the margin call. All right, margin closeout. This is, this goes hand in hand with the margin level and the margin call, right? Now, this all depends on your broker, because my broker, their margin closeout is 60%. Based on most brokerages that I've seen, the margin level that will determine the closeout falls anywhere between 30 and 70%. Now, some brokers don't even have margin closeouts. Unfortunately, if you're in the US, you don't have access to any of those brokers. I don't either. So, go USA. But make sure you check with your broker to see what the required margin level is. Like I said, it'll be different for every broker. And once your margin level drops to those levels, your account equity will be zeroed out. So you'll get a margin call. For instance, my brokerage is 60%. That's the margin closeout. I'll get a margin call when that margin level hits 130%, right? Now, typically, I try to trade at least 1,000 to 1,500% margin level. That follows my risk to reward. Now, not everybody does that. You could get away with 300%, but know that the closer you get to that margin closeout, the more vulnerable you are, right? Your broker could trade against you, knock you down, 50%, which won't require much on their end. Meanwhile, they're still making profit, and then when your account gets blown, they just made even more money. So, definitely be smart. That's the whole purpose of leverage and margin trading, because this is stuff that you really have to start paying attention to. Now, another big question I have, especially from people just starting out, is how to prevent from crashing my account. How to prevent those margin closeouts. And I've broken it down to basically 4 ways. One, if you don't have enough experience, then don't trade with an overleveraged account, right? Like I said, that 1,000 to 1 versus that 50 to 1. Yeah, it's gonna be nice when you're making money, but when you lose money, you're gonna be losing 20 times more, right? And so, ideally, if you want to trade with an account that has more leverage, you want to be a more profitable trader. You want at least 90% of your trades to be profitable. That way you can those trades compensate for those losses, and you're still within a good risk to reward ratio. Number 2, you keep track of your trades. I can't stress that enough. If you can't monitor your trades, then you should maybe think about setting stop losses and take profit levels, just to make sure that your account is safe, because the market news could happen at any second. And even if you're a comfortable, experienced trader, News could just break out at any second. You could be watching the news, but the actual news that takes place in the market is live. We won't hear about it till an hour, 2 hours, 3 hours, even 4 or 5 hours after it happened, right? So the market is live and it has no remorse. If you can't keep track of your trades, then you need to be losing. You need to be using stop losses and take profit levels. All right, and then number 3 is start closing individual trades to release some of your margin used, which I mentioned earlier. And number 4 is to deposit or transfer more funds into the account. Now I have that listed as number 4 because this should be your last resort. When I started out, I blew accounts left and right. I would not deposit more money into those accounts. I would build it back up. So if my account went from $200 to $3, I would build it back up from there. And what that will teach you is patience, right? Because one trade could just completely take away everything that you have left in the market. So, I have that listed as a last resort, meaning, you have no other choice, right? And when I say you have no other choice, is like when you learn how to calculate margin closeouts, which we'll go over, if your margin closeout will put you in the negative, then deposit or put more money into the account, because you're gonna have to do it again anyways, right? But still, that is that's the entire lesson for lesson 1, going over leverage and margin trading. I hope you find this information, or I know you'll find this information useful. I hope that you apply it, and I look forward to seeing you all in the next lesson. So today we went over the definitions, and we talked about how to prevent margin closeouts, which is a big issue. And in the next lesson, we'll go over everything again, but we'll go over the calculations for each. So you'll definitely need to be taking notes. So after this lesson, you're going to want to go log into GCU if you're not already, and take the quiz, get at least 90%, and get ready for lesson 2.